So let's start with the session, everyone, now. So in this first chapter, we will be discussing about what should be the engagement responsibilities, or as a CPA, what all responsibilities you can take. This is something we are discussing in the very first chapter. But before I'll start with this syllabus, before I'll start with our first class, I just have something, I just want to discuss something with everyone. No, with Glim we are doing, but no worries. Payal, I'll definitely help you what all topics you have to do from the Becker as well. And these PPTs will be like notes for you. You can like these are the basic notes. You can use it at the time you are preparing for the exam. Okay. So, but definitely I'll help you with what all topics we will be the same topic I'll specify from the Becker as well. Because I've discussed, I'll share it. I'll share it. One second. I'll check if I get it. Okay. So before I'll start with this syllabus, this auditing syllabus, auditing, I'm not saying anything that it is very tough, but just make sure about one thing. Auditing is a paper in which CPA will not easily pass you. They'll never pass you easily. It is uh, not at all an easier paper in terms of passing. When we are talking about the average passing percentage, it is one of the lowest in all the papers we do in a CPA. Right now, even in FAR also, they are doing that. They are not passing easily, even in for FAR also. But auditing is the toughest paper. Like even before this elective scheme have not been introduced. When even I have given my papers at that time also, auditing is considered as one of the most difficult paper. So but guys, don't try to learn anything. Try to understand what are the concepts. Try to practice more and more, whatever the number of questions given in your manual, given in your practice platform. Just try to solve each and every question. Don't try to learn anything. If you try to learn, you'll forget. You're not able to do the evaluation and application part properly. Till knowledge and understanding, the learning will work. But when the question will be testing your evaluation skills, testing your application skills, then learning and understanding will not help you out. So make sure you will be understanding, you will be taking care that you know the concept. And when you know the concept, you should be doing some application as well in the form of practice questions. Direct questions are least likely to be tested in the exam. So make sure just go through to the core of the topic before you are moving to the next topic. Okay. See, you can appear at any time. There is no best quarter I can say. But if you want to appear like uh, mainly, I think as and when you are ready for the examination, you can sit at that time. It's not any specific like paper is easier in any particular quarter. It's not that. So suppose if you are done with the syllabus by June, make sure like if you're done with the syllabus, like if we are starting now, we can easily complete our syllabus by March. So you can prepare for the May attempt or June attempt. You can prepare for that. But one more thing, guys, have you given any other paper or this is your first paper? Any one of you have given any other paper or this is your first paper? You can unmute yourself and you can speak.
It is my first paper.
First paper. Preparing for also. So Payal, you are watching the recorded sessions or I think you are not coming in or you are starting from the fresh batch?
For the file,
For the far, yes.
I already took that.
Okay, you have given you have taken the classes. So have you
Yeah,
given
yeah.
your exam also?
Ayush Bajaj sir, from Ayush Bajaj sir.
So have you given your exam as well?
No, 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 not yet.
Not yet. Okay. Okay. So when you are planning for your exam for far,
Feb end or March mid maximum.
okay. Fab end on March mid. No worries. So if you think you have any doubt in the far also, that's fine. You can ask me directly. That's fine.
Yes, yes.
So we are starting with the first unit, engagement responsibilities. So in the first three units, we will be discussing about what all engagements and as a CPA you can take. So the first is audit engagements you can take, then accounting and review engagements you can take, then attestation engagements you can take, and the last one is related to quality control, which is about the firms. So first, I'm starting with the engagements. What is the overview of engagements? So these all are the engagements an auditor can take or a CPA can take. So the first is preparation. You can prepare the books of accounts of a company. You can do a preparation. For preparation of financial statement, definitely you will not be connected with, you are not an independent person. So you are not going to give any assurance, no report, nothing. You have to just prepare the financial statements of the company. So no assurance, no report is required. Compilation. Again, in the compilation, you are not going to give any assurance. You are just giving a disclaimer on any assurance. So no, again, for the preparation work, you are preparing the financials using the journal entries or whatever the ledger accounts are there. In the compilation, you are just compiling the books of the company. Again, you are not giving any assurance. No report, nothing. Reviewing means here in the review is not similar to an audit. Review is like you are reviewing some specific area of operations. You are reviewing the specific area of operations. Like the bank have hired you to review the credit position of a company. So in that case, you will not give an assurance. You will not give a reasonable assurance. You will only give a limited assurance. Limited means you will not be giving your opinion. No opinion is being provided. You cannot give your opinion that according to me, the credit position is not good. So don't invest, don't give a loan to the company. No, nothing. You'll only give your conclusion that what you feel about the credit position of a company. You'll give a conclusion. There is a specific topics in the coming session. We will be discussing in very detail these topics. Next is examination or audit. When it comes to audit or when it comes to examination, audit is more lengthier form, I would say. It involves like examining the financial statements of the company, making sure that it is prepared according to the US GAAP. This is something we will be doing. So we give a positive assurance. Positive means we give a reasonable assurance. So what is reasonable assurance? What is absolute assurance? That is something we'll discuss afterwards. Reasonable assurance we will be giving, or we will be expressing our opinion. When we are expressing our opinion, we are giving a reasonable assurance only. And the last is agreed upon procedures. Agreed upon procedures means like somebody have hired me and asked me to perform these procedures, to do these procedures. Whatever the process is being defined, I have to just complete that. That's it. Nothing else. So results of the procedures we have to provide. No assurance. We have to just take out the factual findings and give it to the management or those who have hired me to perform those procedures. So that is the result of the procedures.
Sir, just one question. Can we relate this review with the standalone, like the quarterly results that can be declared by the listed companies?
Yes, you can do that.
Okay.
Because ultimately in the interim reports also, we never get the reasonable assurance. You can connect it.
Okay, sir.
So we will be using these pronouncements in our auditing syllabus. We will be using the statement on auditing standards. So statement on auditing standards, in this we have like US gas, which is generally accepted auditing standards, which are being issued by the AICPA. And these standards are mainly applicable on the non-issuer companies. It will be applied over the non-issuer companies, not on the issuer companies. Then we have the standards on auditing, which are being issued by Public Company Accounting Oversight Board. And these are mainly for the issuer companies. So there are multiple standards for auditing. When you are auditing the public companies, you have to follow the Public Company Accounting Oversight Board standards prepared by them. If you are auditing the financials of non-issuer companies, you have to follow the standards which is being prepared by the EICPA. So standards, statement on standards for accounting and review services we have. Then we have the statements on standard for attestation engagement. So SSARS and SSAES. These are something we have. Then we have a SOX Act, Sarbanes-Oxley Act of 2002. These all we are going to discuss in our syllabus. So first, I'm starting with the overview of auditing engagements. So what is an audit? So what is an audit and why the audit is being done? So when I'm saying the audit, the main purpose of an audit is to provide the financial statement users with an opinion by the auditor. Suppose I am the user of the financial statement. I need a confirmation that the financial statements that I am looking into, whatever the financial statements I am using, it is these financial statements are presented fairly. I want a confirmation for that. That whether the financial statements are presented fairly in all the material respects in accordance with the applicable framework. This type of confirmation I need. That is an audit. Suppose I am a user of financial statements. I'm sure, how I'll be sure that whatever the financials the company have prepared, it is accurate. It is prepared according to the financial reporting framework. How I should know that? Mainly, I'll get a confirmation on the basis of auditor's report. If auditor is giving, I would say auditor is giving an opinion regarding financial statements are prepared in accordance with the framework, I'll be confirmed, I'll be sure that yes, financial statements are appropriate. We are sure about that. Otherwise, we are not sure. So if we want a surety, that's why the audit is being done. So the purpose of an audit is to provide the financial statement users with an opinion by the auditor on whether the financial statements are prepared fairly in all the material respects in accordance with the applicable financial reporting framework. So now what are the objectives of audit? What are the objectives of audit? So objectives of the audit is to obtain the reasonable assurance. Now, what is a reasonable assurance? When I'm saying a reasonable assurance means I'm not giving a guarantee. As an auditor, I can never give a guarantee that the financial statements are absolutely correct. I can never give a guarantee for that. Why? Because as an auditor, I cannot go through each and everything within the financials. I cannot look into all the transactions which the company have entered into. I cannot look into all the transactions. I can only give a reasonable assurance. Means I cannot guarantee that if the financial statements are wrong, anything is wrong. I'm giving a guarantee nothing is wrong. If anything is wrong, uh, you can just go against me, or you can just file a complaint against me. No, I'm not saying that. I'm saying that I have to complete an audit within a given time. So I'm not able to go through to each and everything in an appropriate way. That's why I can't give an absolute assurance. I can only give a reasonable assurance that whatever the financials are prepared, it is according to me, it is appropriate, it is correct according to me only. So obtain the reasonable assurance about whether the financial statements as a whole are free from material misstatements, whether due to fraud, due to errors. So according to me, the financial statements as a whole are free from material misstatement due to fraud, due to errors. This is something I'm saying. So now what it means by material misstatement? Can anybody please let me know what is the meaning of material misstatement?
That affect the decision of the financial statement users.
Okay. Anyone else?
Anything that can influence the decision of financial statement.
Okay, absolutely. So when I'm using the word material, what does this mean? When I'm using the word material, material means material items are those which can affect the decision of the user of financial statements. Suppose I'm a user of financial statement. Whatever the items that can lead to the change in my decisions. Suppose there are some items which can affect my decision, which can ultimately, if those items are not correct, ultimately I can say if those items are not correct, I cannot take the right decision. So that is the material items. Some of the items can be material, some of the items can be immaterial form. If I can say this item, if it is wrong, I cannot take the right decision. If this item is correct, I can take the right decision. So that is a material misstatement. If material items are wrong, that is known as material misstatement. Material misstatement can be based out of qualitative, based out of quantitative things. And whether the item is whether the item is material or not, most probably it is decided by an auditor. Like if I'm saying, if any error is over and above $50,000, then it is a material error. So we just fix a threshold. So according to the threshold limit, we specify whether the error is material or it is immaterial. The second thing we decide on the basis of materiality is qualitative. Qualitative means if the error is so important that it will be affecting the financial statements and there is a huge impact will be there over the financial statement of the company, it will become a qualitative error. Qualitative reason of the material misstatement. If any error is affecting the decision making of a user, like error in calculation of closing inventory. So it is known as material error, I would say. It is known as material misstatement. So even if there is a error of, let me say, $10,000, still it is a material error, because when the ending inventory is wrong, it will not be affecting just the financial income statement of the company. It will be affecting the retained earnings balance. It will be affecting the balance sheet of the company, a lot of things. So it is a material misstatement. So we have to obtain the reasonable assurance whether financial statement as a whole are free from material misstatement, whether due to fraud, due to errors. These misstatements can be because of fraud, can be because of error. If there is a fraud, how we can say anything is a fraud? If it is intentional, it is a fraud. If it is unintentional, it is an error. Then auditor have to report on the financial statement and communicate as required by the GAS. So it's an objective of an auditor to report on the financial statement of the company and communicate as required by the generally accepted auditing standards in accordance with the auditor's finding. Then the last objective of audit is the auditor have to be independent and comply with the ethical rules. This is also being specified within the audit report of the company. That auditor needs to be independent and auditor needs to comply with the ethical rules, ethical principles. So please take a minute, everyone. Just go through to what we have discussed here and let me know if anything is not clear.
So actually, I have only backup book.
Okay.
So how can I
What I do,
just give me a
mainly,
solution now?
I can just suggest you one thing. See, I don't suggest you to do both Glim and Becker both. What I do, just to simplify everything, I can share the Becker, this Glim book with you. Okay. So the questions, whatever the practice questions are there, practice questions most probably remain the same. Either you are using the Becker or you are using the Glim, it will be most probably same. It will not be a problem. The main thing is like whatever the concept we are doing in a class or whatever is in your book, it have to be same. Like for that thing, I can suggest you, I can share the book with you. You can refer the book. I'll also share these PPTs. So this will help you out with in clearing the concepts. And when the
Is it
concept is
not
clear,
possible to find the similar topics in the backup book and then write it down there or note it there?
uh, I can just I'll provide you the like what I can do. Like this is one way. The second way is like what I do is like I can just point out which topics we are doing and which chapter is there in the backer. Like it is chapter number 1, chapter number 2, whatever the chapter is there. I can just help you with that.
Yeah, please do that.
I'll also share the book of Glim. If you think
Yeah, sure.
like you have to do it from Glim, you can do it.
Yeah, sure. Because the thing is, I have only backup access, so I will be practicing questions from backup only.
Okay,
And to practice questions from backup, I need to relate that with the topic in the backup book only, right?
right. For that, it is important. You are right.
Yeah. So
Yes,
please
Dipti,
just
I'll share
refer me
it.
the chapters in backup.
Yeah, yeah, sure.
Sir, I have also requested for PDF to be shared till the books are dispatched. So if that can be done, that would be more helpful.
See, here I can share, but I'm not getting an option to share it. What I do, like you can WhatsApp me directly, and I can just share my number with you. You can WhatsApp me directly, and in case of any doubts as well, you can WhatsApp me directly. And even the books, I'll share it with you directly over the WhatsApp. Okay.
Sure, sir.
So I'm sharing my number. Now, the next thing is professional skepticism. So, what is the professional skepticism? And how it is important for an auditor? So, professional skepticism is like, I can say any CPA needs to be skeptical. CPA needs to be spectacle. How? They should have a question in their mind that why the company is doing this, why the company is not doing it that way. These type of questions they should have in their mind. Like if the company is doing in a different way, why the company is doing in a different way, they should have a question in their mind. So that is something is very important. The first thing is a questioning mind. They should have a questioning mind. They should have alertness to the condition that may indicate the material misstatement. They have to be very alert that what conditions are there that may indicate the material misstatement. Like when I'm just going through to the financials, when I'm just going through to the transactions of the company, I just I just get something which is like triggering, like some balance is wrong. In the journal entry, we have seen the sales of $50,000, but when I check the ledger account, I just have seen the same journal entry, same recording is there, but they have posted $55,000. This is a triggering events, and we have to be very, very alert towards these type of things, because alertness to these conditions, this may indicate the material misstatement. Next is critical assessment of audit evidence. Whatever the evidence I'm collecting, see, it's very important. Whenever the auditor is giving an opinion should be on the basis of appropriate audit evidence. If they don't have the appropriate audit evidence, they can never give their opinion. So appropriate audit evidence is very important. They should have the appropriate audit evidence to give their opinion. So critical assessment of audit evidence should be there. They must be doing a critical assessment of their audit evidence. Without that, auditor can never give their opinion. It's very important. So first thing is they should have a questioning mind. They will be alert to the conditions, to the things that will be indicating the material misstatement, that will be showing that misstatement will be there in a company's financials. Then they will be doing a critical assessment of whatever the evidence they have collected. They will be critically assessing those evidence. So that is about the professional skepticism. So please let me know, everyone, if anything is not clear. I need a quick update if this is clear or not. Okay. Okay, so now I'm just coming to the biasness. How the auditor is biased. How we can say there is a biasness will be there from the side of auditor. This is something we have to look. One second, please. Okay. So we are starting with the biases. So first we are starting with the availability biases. Availability bias. So we can discuss it with the help of one example. So when I'm saying availability bias, like as an auditor, suppose I'm saying I'm just going for an audit, and as an auditor, we get something, like we get some information, and we feel that whatever the information I get initially, that same information will be applied over the other things as well. Like after hearing a news about a plane crash, someone thinks air travel is more dangerous than it actually is. That is the availability bias. Like I'm saying, so it's like a tendency that we place more weight on the events or experiences that immediately comes to our mind, or those events which are readily available. Means we judge the likelihood or importance of the event based on how easily uh, it examples to our mind come to our mind. So sometimes what happen, auditor place undue weight on information that is most recent or easily recalled. Suppose an auditor underestimates the fraud risk because no fraud was detected in the recent audits. So that is the availability bias, I would say. Like in the recent audits, auditor do not get any, like auditor is not able to identify any fraud. So auditor is saying that fraud risk is less. So this is something is the availability bias. Next is confirmation bias. Like confirmation bias means auditor seeks more on evidence that confirms their initial assessment and ignores the contradictory evidence. What they do, they make a confirmation, and according to the confirmation, they make sure about the things. Confirmation bias is like an audit. So I would say auditor relies more on evidence that confirms their initial assessment and ignores evidence. Whatever the contradictory evidence is there, we ignore it. We say initially we confirm it. So if we get even some different evidence as well, we ignore it. For example, we can say auditor accepts the management explanations, which is supporting the inventory valuation, and does not investigate some indicators. This is something possible from auditor's side. Auditors do these type of things. Like auditor accepts whatever the management explanations are, but mainly what the auditor have to do, auditor have to investigate if anything is coming to the auditor's mind, they have to investigate that. If like they're doing anything and they find any contradictions, anything which is wrong, so what they have to do, they have to investigate. But they don't do that. They just accept the management explanation and they move forward. This is something is a confirmation bias. Next is the overconfidence bias. So what will happen in the overconfidence bias? We can say when auditor is ultimately overestimating its own ability to make accurate assessment. I'm saying I'm an auditor who is doing an audit from last 10 years. Nobody can beat my estimates. It's an overconfidence bias. And whenever there is an overconfidence, it will lead to a problem in the audit. When auditor overestimates their judgment, or experience. So, for example, I can say an experienced auditor I would say I'd seen that even practically also, an experienced auditor reduces the sample size. Believing that their judgment alone is sufficient. So this is something is the overconfidence bias. Next is the anchoring bias. Anchoring means auditor just stick to some information and they're saying if this information is wrong, everything is wrong. This is anchoring bias. So auditor relies, we can say, too heavily on the initial information or prior year conclusions when forming the judgments. So I can say auditor relies too heavily on initial information or prior year conclusions when forming judgments. Like I would say, auditor uses the prior year materiality without properly reassessing current year conditions. Whatever the previous year conditions are there, auditor just pick up whatever they have decided in the previous year, and accordingly they don't make any reassessment for the according to the current year situation. That's the anchoring bias. Next is the last one is automation bias. When auditor started more relying over the automation, when auditor starts relying more over the automated tools or audit software without sufficient professional skepticism, that is the automation bias. So we can say when auditor places, these are the basic things, I would say. Excessive reliance on output of automated tools or audit software.
without sufficient professional skepticism. It's an automation bias. It is an automation bias, we can say. Suppose if the question asks which bias threatens the professional skepticism, I would say all the above will qualify. Because professional skepticism somehow is being, I would say, threatened in every bias we have. Availability, confirmation, overconfidence, even it will be bias in every case, I would say. Anchoring, automation, everywhere. There is a bias. I need a confirmation from everyone.
Sir, what are the pros and cons for this auditor biases?
See, I would say when I'm talking about, so each and every bias have its own pros and cons. So cons is like professional skepticism is like missed. If auditor is not following the professional skepticism, like they don't have a questioning mind, they're not looking into everything in detail, they're not able to find out the material misstatement. I would say professional skepticism is not properly applied by the auditor. So it's like a con for every bias. Pros is not there, cons is always there. Like availability bias is there, like I'm not just going through everything properly. Whatever I am just able to recall, I'm just following that. I'm saying uh, a lot of crash cases are coming for airplane. So I'll not sit in the airplane. Even if I'm going for it by a train which is taking like 24 hours, I'm not using a plane even in that case. I need to be like I have to reach to the place in a given time, but still I'm not using it. That's a availability bias. Like I know this area is something which is concerning, but I'm very sure in my mind that this is something I will never look into. Like I feel that production manager is doing a wonderful job. So I'm not looking into anything related to production. I'll be leaving it as it is. I'm saying this is correct because production manager is doing a great job. He's my friend. He's like someone who I know very well. So it's the availability bias. Confirmation means I take the initial confirmation and on that basis, I'm just taking all the decisions. Management give me an explanation that how they are valuing their inventory and I'm very sure that they are doing it appropriately. I'm just ignoring whatever the evidence I'm getting. So that's a confirmation bias. Overconfidence means it's, I would say, each and every bias have its own cons. And most of the time it is not good. It's not good at all. It is always having a cons, not the pros. Pros are not there, only the cons is there. Overconfidence means I'm an auditor who is like having a lot of experience. I just reduce the sample size and I'm saying, no, there is no need of a large sample size because I'm already very confident. With this sample size only, by using my experience, I can find out any misstatement. It's an overconfidence. Anchoring, automation in the same way are the biases.
Yes, sir, for me.
Clear, sir.
What about others?
Clear, sir.
Okay. So now we are moving to the next thing. Whenever we are talking about the audits, in audits, it's very, very important that auditors should obtain the sufficient, appropriate audit evidence. Like if the auditor is not able to obtain the sufficient, appropriate audit evidence, I feel that it's not going to be a good audit. So auditor needs to collect the sufficient, appropriate audit evidence, because it is important to reduce the audit risk. If we have to reduce an audit risk, it's most important that they should collect appropriate audit evidence. They should collect it, because with whatever the evidence they are collecting, it will reduce an audit risk to acceptably low level. Means ultimately what they have to do, sufficient evidence needs to be collected, needs to be obtained. And sufficient evidence, how much is the sufficient evidence? This is something changing from company to company, changing from situation to situation. In some situation, we need less evidence. In some situation, we need more evidence. So it will be changing from situation to situation. And we have to make sure that whenever we are collecting the evidence, it should reduce the risk to a low level. And the next thing is, and thereby enable an auditor to draw the reasonable conclusion. Sometimes auditor is not able to collect the proper evidence. And if they don't collect the appropriate evidence, they cannot reach to any conclusion on which they can base their opinion. So if they have to base their opinion, they have to draw the proper if they have to draw the proper conclusion, they should obtain the evidence, and ultimately it will enable the auditor to draw the reasonable conclusion on which to base an opinion. If they are giving a modified opinion, why they are giving a modified opinion, they have a reason for that. Why they are giving an unmodified opinion, or why they are giving an adverse opinion, they should have a reason for that. And to take all those reasons, to find out all those reasons, they have to obtain the reasonable audit evidence. Otherwise they can't obtain they can't reach to any conclusion. So ultimately we can say the auditor have to obtain the sufficient, appropriate evidence, audit evidence, which ultimately can reduce the risk to a low level and ultimately enable an auditor to draw the reasonable conclusion on which to base their opinion. Now, there are 4 different types of opinion an auditor can give. Unmodified, unqualified, we can also say, then qualified, adverse, or disclaimer. So when I'm saying unmodified opinion, unmodified means there is no changes are required. Nothing is required to be changed. Everything is up to the mark. Nothing is required to be changed. That is an unmodified opinion. So financial statements are presented fairly in all the material respects. And it is prepared in accordance with the financial reporting framework. This is something I'm saying. I'm saying that financial statements are appropriate. There is no error, there is no fraud, nothing, no misstatement, nothing is there. Financial statements are prepared according to the framework. One second, please. So what I'm saying, so first I'm saying unmodified opinion. Unmodified means I'm saying financial statements are presented fairly. It's absolutely fair. There should be no errors. Nothing is there. There is no error. There is nothing, no error, no fraud. Nothing is there. All the things are appropriate. So financial statements are presented fairly in all the material respect in accordance with the US GAAP. When I'm saying qualified means I'm saying except for some matters, except for few matters that is being specified in the report. Means I'm saying these are the few things where I feel that some material misstatement is there. Except that, the financial statements are presented fairly in all the material respects in accordance with the applicable framework. I'm saying except for that, except for this, my financial statements are appropriate, is absolutely fine, absolutely correct. This is something I'm saying. Qualified opinion. So there is a proper paragraph in which I'm writing whatever the material misstatements are there, that is something being specified. And accordingly, I'll be preparing the financial statements. The next we have is an adverse opinion. When financial statements are not prepared, are not presented fairly, then definitely I'll give an adverse opinion. I can't say that except for few things, everything is correct. I can't say that. I can never say that except for few matters that is being specified, everything is correct. I can't say that. I can say, according to me, nothing is appropriate. Whatever the significance of the matters we have described in the report, the financial statements are not presented fairly. Means when there is a few errors, nothing is very complicated, I give a qualified. When a lot of complications are there, nothing is correct, or a lot of errors are there, which will be clearly showing the financial statements are not appropriate, I give an adverse opinion. And the last is disclaimer. Disclaimer is being given when I'm clearly saying that I'm not able to obtain the sufficient appropriate evidence. whatever the evidence being needed, I'm not able to obtain that. I'll give a disclaimer. I'll say no, I'm not going to express any opinion here. I don't want that. So because of the significance of the matter described in the audit report, the auditor has not been able to obtain the sufficient appropriate evidence. Like somebody in the company have not allowed me to just take out any information. I'll give a disclaimer. I'll say no, I'm not able to obtain an information, whatever is needed to give a report, to prepare a report, to give an opinion. I'm not able to obtain that. So I'll give a disclaimer.
So can you elaborate with an example?
Yes. All the opinions you're asking?
Except unmodified.
Unmodified.
Except unmodified.
Except unmodified. Okay. 1 second. Okay. So first of all, unmodified opinion means everything is correct. Okay. So everything is prepared according to the framework. No material errors is there. No material financial misstatements is there. Nothing is wrong. Everything is appropriate. I'll give a unmodified opinion. So like auditor verifies the inventory, revenue, expenses, and find no material misstatement. Accounting policies are properly applied, disclosures are adequate. We give an unmodified opinion. Okay. Now the next is qualified opinion. Like, 1 second, please. Like for modified or qualified opinion, I can say, I can take an example here. Suppose depreciation on plant is incorrectly calculated. Causing a material overstatement. But a material overstatement of profit, but other areas are fairly presented. So we can say, we can in this case give a modified opinion or qualified opinion. So auditor, one more thing can be there, one more example we can say, suppose auditor could not verify the opening inventory due to lack of records. Okay, so in that case also modified opinion, qualified opinion can be given. Next is adverse opinion. When the misstatements are material and it will be affecting the financial statements as a whole, it will lead to an adverse opinion. So adverse, I can take an example. So company prepares the financial statements on a cash basis. Instead of required accrual basis. It is significantly affecting the assets, liabilities, income and expenses. All the things will be affected. So it will lead to an adverse opinion. The next is disclaimer. Suppose management restricts access to accounting records. And key documents. And alternative audit procedures are not possible. So mostly in that case, they give a disclaimer. Suppose management just restrict my access to accounting, my access to the records, whatever the key documents, I'm not able to perform the alternative audit procedures. These are not possible. So in that case, I'll give a disclaimer. When I'm saying I'm not able to perform my audit process, how I can give my opinion? I can't give it. In that case, I'll give a disclaimer. I'll say, no, I can't give my opinion. When only few errors are there and it is not affecting the financial statements as a whole, I'll give a qualified opinion. When there is a huge effect will be there over the financial statement, it will be affecting the entire financial statements of a company, affecting the assets, liabilities, income, expenses, everything, I'll give an adverse opinion. In case management just restrict me, management is not allowing me to take out the accounting records, key document, I'm not able to perform any audit procedure. So I'll not give any opinion. I'll give a disclaimer here.
So in what case this disclaimer is possible, as the management is the one who is appointing the auditors?
So in case of final audit, it's not management who is appointing. It's a shareholder who is appointing an auditor. That's why when we prepare the report as well, that report will be referred to the shareholders of the company, not to the management.
No, but the auditors' names are being suggested by the board only. So
Yes.
how then how can they be restricted for access and all?
Practically, I would say in only few cases they are restricted. Like in some cases, what happened, like the loan, like the bank is appointing me. In that case, they restrict. Like they say that no, you can't use, you can not use these documents. You can't go through to these documents. When sometimes there is a possibility when management is doing something wrong and they want that shareholders should not be disclosed for that. In that case, they restrict auditor in any case, even if they are referring the name. But
So in what cases bank can appoint an auditor for company?
it is possible, like when already there is a lot of loan will be there over the company and company is highly dependent on the debt. And suppose if company wants some more debt from the bank, they ask that if we do an audit and an auditor give a fair report, we can just finalize the loan for you. In those
So,
cases,
but that is a sort of limited review, I guess. That is
even
not.
it is an examination, not an audit. We can say that, because examination and audit is a similar thing. In case of audit, we are talking about the entire financial statements. In case of examination, we are looking to just some smaller part of the company, some specific area of the company. So that is an examination. In case of examination also, we give a opinion. But if if other party do not need an opinion, they need a conclusion. In that case, we need a limited review, limited assurance.
So that means in normal audit cases, disclaimer cannot be there.
Practically, I've not seen that. Like, I'm into audit like from last 14 years. I've not seen that.
No, sir. But is it possible that we get a question related to this?
Yeah, it is definitely possible. Because
Okay.
in Indian companies, you have not seen it, but in US companies, you can see. Disclaimer is possible because in US companies, board of directors are not suggesting any name. It is like in public companies, I'd seen it is a public company accounting oversight board who will be referring the name of the auditors, and shareholders have to select. It's not the board of directors who will be finalizing the name of the name of the auditors. It is the PCOB who will be suggesting the name of the auditors. I'd seen that.
Okay.
So in US companies, it is possible, but in Indian companies, I would say that disclaimer is something I've not seen from last many years. Even for the qualified opinion, if somebody will say, like from last 14 years, I've seen just a single case of qualified opinion. All the cases I've seen is of unmodified opinion.
Okay.
So we
Thank
can
you.
just, you're welcome. So we can now just take a break, and after the break, we can move to the next point, assertions. Okay. So we'll start with our session at 8:40 now. Let's start now, everyone. One second. So we are discussing about this cap croc. These are the assertions. So mnemonic is given, which is cap croc. Completeness, accuracy, presentation, existence, cutoff, RNO, rights and obligation, occurrence, and finally there is a classification. So there is an assertion regarding the transaction and events, and there is an assertion regarding the account balances about the related disclosures. Assertions means when we are going into more detail, like suppose I have to review the transaction and events. I have to check whether I have to check the assertions about the classes of transaction and events, like how any transaction have an impact over the income statement and a statement of cash flow. What I do, I have to check based on multiple assertions. The first thing I have to look is occurrence. When I'm talking about a transaction, I'll be saying whether the transaction and event that have been recorded have occurred. Because suppose I'm recording a sales transaction, I have to make sure that that sales transaction have occurred. Because a lot of the time what the companies do, they can overstate their revenues, they can understate their expenses. They can do that. So any transaction an event that have been recorded have occurred. Next is completeness. Completeness means whatever the transactions and events that should be recorded were recorded. Means whatever the transactions and events are there that we need to record have been recorded, and all the disclosures should be included in the financial statements. So transactions and events to be recorded were recorded. Next is accuracy. So accuracy means whatever the amounts and other data were recorded appropriately. Means there should not be any error. Whatever the amounts we have recorded were recorded appropriately. So amounts were recorded appropriately. Next is cutoff. Cutoff means I'm talking about a cutoff period. Cutoff period means if any transaction or event have been recorded, it should be recorded in the correct accounting period. Transaction and events that belong to 2026 should be recorded in 26, not in 25. That is something is cut off. Were recorded in correct accounting period. Next is classification. Classification means whenever the transaction and events were recorded, it must be recorded in the proper accounts. Like if any sales we have done on credit, it should be recorded in the appropriate debtors account. It should not be affecting the cash account of the company. So that is something is the classification. Transaction and events were recorded in proper accounts. And the last one is, I would say, presentation. Presentation and the correct presentation is very important. If the presentation is not done correctly, it is not presented in the appropriate account, appropriate financial, it's not correct. So as an auditor, we have to look for everything. We have to look for occurrence. Whatever the transaction that is recorded by the company have been occurred. Lot of time it is possible that sales is being recorded, but actual sales have not been happened. Then complete all the transactions and events that needs to be recorded were recorded. Accuracy, amounts were recorded appropriately. Incorrect amounts are not recorded. Cutoff means proper period it should be recorded. Classification means in the proper account. Presentation means properly presented. Then we have the assertions related to account balances. We have an assertion about the account balances. So this is the topic we will do in more detail in the coming chapters as well. So don't worry. Here we are just looking at the basic part. When I'm saying account balances, the first thing is existence. Like if I'm saying, I'm talking about any asset, let me take. So as an auditor, what you do? Suppose if you have to check whether the plant balance is correct or not, whatever the property balance is there, it will be appropriate or not, what do you do? I'll check for the existence. I'll check whether any particular asset exists or not. Sometimes there is a possibility that asset do not exist. We are showing the assets, liabilities were exist. If it does not exist, we do not record it. Then it's most important that we should have the rights and the obligations. Rights and obligation means so ultimately, if we are showing any assets, any liabilities in our books, we should have the right to control an asset. We should have an obligation towards the obligation. We should have an obligation towards our liabilities. That is something important. We can't show the liability of someone else. We can't show the assets of someone else in our own books. That's very important. So entity controls the rights to assets. And liabilities, obligations. They have the obligation towards the liabilities. Next, completeness is there, like completeness can be there, like whatever the assets and liabilities we are recording, it should be complete. Sometimes there is a possibility that company do not disclose all of their liabilities. Then it must be accurate. Accuracy must be there. Accuracy, valuation, and allocation should be correct. Sometimes we do not disclose the correct depreciation amount, so allocation can be wrong. Then classification should be correct. If any asset is a current asset, we will be recording in an appropriate heading. So asset, liabilities, equity were recorded in a proper accounts. It's very important. Then presentation. Presentation means how I'm just showing my assets, liabilities, and equity. Whether I'm showing it appropriately in the balance sheet or not. Lot of time, what they do, what the companies do, like they have to show the lesser liabilities, lesser long-term liabilities. So what they do, they convert the long-term liability into current liability, so that there should be a lesser balance that will be showing in their non-current liability, just to obtain the loan. So presentation should be accurate whenever we are talking about assets, liability, and equity. So assets, liabilities, and equity are properly aggregated. So this is about the assertions. Now please take a minute, just go through to this once.
What is meant by classification in that? Classification as in short term or long term or something else?
Classification means I'm talking about the proper accounts.
Okay.
So anything related to PPE should be recorded in the PPE only, property, plant, and equipment. It should not be recording in some other assets or other assets. Any liability that is mainly related to the long-term obligation, it should be the part of that only. That is a classification. So anything else which is not clear, everyone?
Yes, sir.
Yes. What about Dipti, Rajat,
Clear,
Sejal,
sir.
Uma? Okay.
Sir, I had one
Yes.
query. The new labor code that has been shown basically in exceptional items in most of the companies' balance sheets currently. So, is it the right thing to do? Like, is it been classified properly, or is it?
Labor rules you are asking.
Yes, sir. That labor code that is being applicable from November 25 for Indian companies.
See, if it is like, see, if it is properly is like according to the IFRS we have to do. If IFRS is saying, just like in India, for Indian companies, IFRS is being applied. If so, mostly labor rules needs to be disclosed. And how it is going to be disclosed, like it is the part mostly in the notes to accounts. If it is needed for the users of financial statement, then it is the part of notes to accounts. If it is not needed, then company can include those labor rules within their annual report. It's totally dependent on the company. It is something not related to the numbers. So that's why I think IFRS is not taking care of a lot of these things. But if company thinks they are required, they can disclose it. Otherwise, there is no compulsory thing because there is
No,
no.
but it has an impact. Like there is a impact for like companies like Infosys and all. There is an impact of around 300 crore. So if they are not taking it to the financials directly and they are taking it as an exceptional item, won't like isn't it they are classifying it wrong, or like how is it?
They can take it as an exceptional item. You see, some of the items can be changing from company to company. That how they are considering, because this is something not the part of journal principles. It is something not applicable to everyone. If suppose any accounting body, just like in India, ICAI is taking any action regarding this and they will be providing any appropriate action, then it will become some sort of legal reporting is there. But if it is, there is no specific thing, no specific standard is there regarding that, then it's completely dependent on the company how they want to show it. If they want to show it as an exceptional item, they can do it. But if it is a material item, as an auditor, what I have to do, I have to check whether the threshold is crossing or not. If the threshold is crossing, it will become a material item. And if it become a material item, I have to make a disclosure. An appropriate disclosure will be required
No,
in
no,
that.
sir. They are making a disclosure. They are, I'm not saying that they are not making a disclosure, but isn't it being showing? It should be shown as a part of your employee benefit expenses rather than putting it as an exceptional item.
See, in that case, if there is a specific rule, like there is a requirement that yes, it is the part of employee benefit, we'll take it. If there is no specific rule is there, like a specific principle is there that will be covering it, then exceptional item is also correct. So we
Okay.
have to, if you become an auditor and you have to review that, what do? You'll check whether there is an accounting principle regarding that or not. If there is a specific accounting principle which is clearly saying that no, this is not an exceptional item, this is the part of employee benefit expense, or within the accounting standard, if that point is also being added as an employee benefit expense, then according to us, we will be following a principle. If the
So as
principle,
part of accounting standard, it says that it should be a part of your employee benefit cost, but as companies doesn't have a clarity on this, so to take a hit directly, what we think that it is being done as an put as an exceptional item.
so if it is clearly specified, then company is doing wrong. And as an auditor, you have a some sort of duty to clearly specify that within your audit report. In that case, you can do that. But definitely, if practically, I'm saying, practically, we as a chartered accountant, just like in India, we can never do those things by which we can lose our clients. So we have to look for our clients as well. So what we can do, we can suggest to the management that this is the item, this item is not an exceptional item, so you have to take it to the employee benefit expense. And normally they do it. They make the correction in that. If we clearly show them that principles do not allow them to take it as an exceptional item. So practically we can do that. But
Okay.
if
But as per
even
theory, if you go, then we are supposed to put
see,
a disclaimer or something.
yeah. Absolutely.
Okay.
See,
Okay.
what normally we will be doing, like in the coming session, I'll be like in the coming session, we'll discuss those things as well. Like if company is not doing it like in an appropriate way, but the company gives a proper reason for that, and that reason is appropriate, then even in that case, we can't issue the modified opinion. We can't say company is doing wrong. If the company have a proper reason for that, and they are giving you an appropriate reason why they are not following that thing, then in that case, as an auditor, you can't give a modified opinion. You have to give an unmodified opinion. These
Okay.
things are also important when we are doing the work as an auditor. Now I'm coming to the professional responsibilities. So when I'm saying professional responsibilities, so according to the generally accepted auditing standards and according to the Public Company Accounting Oversight Board standards, we use the following categories of professional responsibilities. The first is an unconditional responsibility. So unconditional responsibility means some of the responsibility remains unconditioned. Unconditioned means there should not be any reason that auditor should not comply with that. So unconditional requirement means there is some of the responsibility remains unconditional, means that responsibility have to be fulfilled by an auditor in any of the condition. Auditor must comply with that. So I would say auditor must comply whenever it is relevant. For example, we can say what are the unconditional responsibility? For example, an auditor must be independent. There is no so there must be no condition for that case. We can't say if an auditor is not independent, he can do an audit in this particular scenario. No, an auditor must be independent in all the scenarios. If auditor is not independent person, he can't do an audit. He or she can't do an audit. It's a mandatory requirement. It's an unconditional requirement and every auditor have to follow it. Next is presumptively mandatory responsibility. So they have to follow it whenever it is relevant, except in rare circumstances. So what are the rare circumstances? We'll be discussing about it now. Okay. So when I'm saying unconditional responsibility, I would be saying no exceptions are permitted here. Means an auditor must be independent in mental attitude as well as appearance. An auditor must maintain the confidentiality of client information. If there is a violation, there is a violation of professional standards. That is an unconditional responsibility. Next is when I'm not using the word must, I'm using the word should. So I would be saying these requirements should be complied within all cases except in rare circumstances. Where compliance would be ineffective, I would say. So here I would use the word keyword should. For example, an auditor should obtain an engagement letter. We can't use the word must. We can use the word should. They have to obtain it. If they're not taking it, it's not like they can't do an audit. Still they can do an audit. So next is an auditor should assess the risk of material misstatement. So this is something is presumptively mandatory responsibility. So I would say these are the mandatory responsibility, but departure is allowed in the rare circumstances. When the auditor is departing, they must document the justification why they're departing from them. Like if I take one example, if obtaining a written engagement letter is impracticable, the auditor document the terms of engagement through alternative written communication. Like suppose company is saying that we can't give an engagement letter, but we will give you a written mail in which everything is specified. So departure is allowed. But for independent behavior, departure is not allowed. If you're not independent, you can't perform your duty. But yes, if you can't obtain an engagement letter, still you can perform your duty. Should consider requirements here now. So the next is auditor is required to consider the action or procedure, whether the procedure is actually performed depends on judgment. For example, we can say auditors should consider the use of internal audit work. It's like they should consider it. If they don't consider it, it doesn't mean there is a violation. Auditors should use the specialist. If any special work is there, they should use the work of a specialist. But it's not mandatory. It's not required. We are not going to use it. There is no violation is there. So it's should consider. So these are the responsibilities. So please take a minute and let me know if anything is not clear.
So can you elaborate on this? An auditor should assess the risk of a material misstatement.
See, there's a requirement from the side of auditor. Like when the auditor is performing an audit, so before deciding the audit procedures, they have to just they have to assess what are the chances of risk of material misstatement. Why? Because if the risk of material misstatement is high, the sample size automatically increases. If the risk of material misstatement is low, the sample size is automatically low. So that is something they have to do, but it's not mandatory. We can't say it must be required. Why? Because it depends on auditor to auditor whether they have to do it or not. It depends on auditor to auditor. So that is why it is a presumptively mandatory responsibility. But it is dependent on auditor. It's a mandatory thing, but it depends on an auditor. If they are not doing that, they have to specify the reason. They have to specify why they have not assessed the risk of material misstatement. This is something is required, but it's dependent on auditor.
Sir, in case of a 1,000 million company, so if we take a auditor has taken a stand that 5% is my material misstatement, I'll not go for anything. Supposingly for 50 million, I'll not see. I'm not going to see anything below 50 million.
Okay.
And can he take the same stand like if it is a 1,000 billion company that he's not going to see anything below 50 billion if it is a 1,000 billion company? Can it be taken?
It's totally the call of totally a call of an auditor. Nobody can question an auditor that why you are not doing this, why you are doing this.
No, because like if we think about 50 billion, it's a big amount. But when we compare it with the 1,000 billion, it's a small amount for him, considering that.
Right. So it's see when I'm talking about these things, this will be changing from company to company. This will be changing from company to company, and ultimately This is not a mandatory thing. That what should be the threshold, it's not specified. If it is $1,000 billion company, it's a different thing. If it is a $50 billion company, then it's a different thing. It will be changing from company to company. And nobody can question why the threshold is this, why the threshold is 5%, why the threshold is not 10%. Nobody can question an auditor. It is a requirement from an auditor to decide what should be the threshold. If threshold is different from what auditor is what others are expecting, auditor have to give the reason for that. Why auditor is taking 5% amount, not the 2% amount, not the 10% amount. Auditor have to give a reason for that. I think your
And sir, the last one also, the auditor is required to consider the procedures. So they have a standard procedure. Supposingly, if we talk about Big Four companies, they have a standard procedure to check their
but
do the audit.
It's not a legal requirement. It will be depending on the Big Fours. They have their audit procedures defined. Even for internal audit, they have a questionnaires that is being defined. A lot of things are already defined, but it's not a legal requirement. They should consider it, but it's not mandatory for an auditor.
Okay. So, sir, then what is mandatory here, if you can say?
Like they have to be independent. This is mandatory. They have to maintain a confidentiality. This is mandatory. They must have to follow anything that is must for an auditor. That is I would say is an unconditional responsibility. If I would be saying they have to, they should collect an engagement letter, this is a mandatory responsibility, but still exception can be possible. We have to follow, we have to assess the risk of material misstatement. This is mandatory, but still exception is possible. For anything that there is an exception, it is a presumptively mandatory requirement.
So taking a MRL is a mandatory, or it is an exception, can be considered, should be considered?
It should be considered. It must not, we can't use the word must there. Because exception can always be possible for many things. Exception is possible. But if you are an independent person or you are not an independent person, there is no exception is there. If suppose you are not maintaining the confidentiality principle, there is no exception is there.
Got it.
In case of unconditional responsibility, there is no rare circumstances. It must be followed. In case of mandatory responsibility, there can be a rare circumstances. It is possible. Now I'm moving to the audit reports. Very important. This is something we'll do in the second last chapter as well, 19th chapter. We have this entire audit report related things in 19th chapter only. So we'll discuss these topics in more detail at that time. So the first thing is, before I'll move, I just want to know if anybody have an idea about this word pervasive.
What is pervasive in audit?
Sorry, can you please repeat it? Anyone? So there can be an error. Okay. There can be the material misstatement. There can be the material errors. But some of the misstatement can have an effect on financial statements as a whole. some of the errors can have an effect on the financial statement as a whole. That is something known as a pervasive effect. Pervasive means if there is an effect on the financial statement as a whole, it is known as pervasive effect. So now we are talking about, now I'm starting with this topic, a reason for modification. So in one side, we have a reason for modification. In other side, we have a auditor's judgment about pervasiveness of the effect or possible effect on the statement. The first is financial statements are materially misstated. Financial statements have some misstatements, but it is material but not pervasive. Material but not pervasive means it will have a material effect, but it will not be affecting the financial statement as a whole. These are not affecting the financial statement as a whole. Then we give a qualified opinion. But if the effect is material and pervasive, it is a material misstatement and it is affecting the financial statement as a whole. In that case, we give an adverse opinion. In the same way, if an auditor is not able to obtain the sufficient appropriate audit evidence, then if it is having a material effect but not the pervasive effect, then an auditor gives a qualified opinion. But if it will have a pervasive effect, it will have, like auditor is saying that I'm not able to collect any information, or whatever the information I'm not able to collect, it will be affecting my entire opinion. Then in that case, auditor will be giving a disclaimer. If auditor is saying no, whatever the evidence I have collected, I'm unable to obtain the sufficient evidence, but I'm still able to collect lot of evidence by which I cannot say that entire opinion I can give. Some opinion I can give, so I give a qualified opinion. If anything have an effect on the financial statement as a whole, then I'll give a adverse or disclaimer. If not pervasive, then in any case I'll give a qualified opinion. So please take a minute, guys. I'll be back in a minute. Let me take some water. I'll be back in a minute, please. Yes. Guys, you can let me know your doubt if anything is not clear. Yes, everyone. Okay. So I think we can move to the next point. Yes, Dipti, Payal, Rajat, Sejal, Uma, any doubt?
Yes, sir, clear. No, sir, no doubt from my side.
Clear, sir.
No doubt,
Oh,
sir.
okay. So now I'm coming to the overview of accounting and review engagements. So first of all, I'm saying preparation, compilation, and review. So preparation engagement, first of all, it is a non-attest service that does not require the accountant to be or to determine whether he or she is independent of the entity. So when I'm saying preparation service, for preparation, I would say there is no requirement that accountant should be independent person. No requirement of independency is there. It's not required an accountant should be independent. So ultimately, it's a non-attest service. It does not require any accountant to be or to determine whether he or she is independent person. So there are some items that accountant need not perform. That is, verify the accuracy or completeness of management information, obtain the evidence to express an opinion, or report on the financial statements. They are not going to do these things. Then accountant engagement cannot be relied on to identify or disclose the misstatements or the frauds. So accountant should not be involved in identifying the misstatement or finding out the frauds. Auditor should not be involved, accountant should not be involved in that. In that case, it is known as non-attest service. So list of the items are, list of the items means verify the accuracy, or completeness, or obtain evidence to detect any errors or to express an opinion, or to prepare a report on the financial statements. So this is something is the part of preparation. So preparation service ultimately allows the accountant to use the software to generate client, we can say to generate client financial statement and release them to the client or the third parties without attaching a report. They're not going to provide any report or nothing. They have to just extract all the information from the financial statement and give it to the client. That's it. Next is the compilation.
I had a doubt.
Yes, please.
You're saying the verify the accuracy, but if the accountant are not accurate with the numbers, so is that accuracy you're talking, or you're talking about some different prospect?
So I'm saying I can verify the accuracy only when I'm an auditor. I don't need to verify an accuracy if suppose I'm just the part of a preparation service. I'm just involved in the preparation of the financials. I don't need to like verify the financials of the company. This is something I'm saying.
No, sir. I mean to say, like, if there is supposing a sale of around 100 CR, so and if there are thousand of bills, and if the accountant is only doing for 90 entries for 99, and there is a miss of one invoice of supposedly 10 CR. So is that he's not checking the accuracy? So will that be counted as an accuracy that we are talking about, or
Yes, that
is
will be
is
counted
it
in
the
the
duty
accuracy.
of the auditor?
It is the duty of auditor, not an accountant.
So, but he's also
See,
supposed to give the numbers correctly, isn't that?
Practically what if we are talking, if whatever you are saying is practically not possible right now, because everything is done right now. If I would say there is no need even to record a single transaction, there is no need. Why? Because whatever is happening, everything is being recorded through the accounting software. So there is nobody who is involved in recording the transaction right now. Right now, everything is recorded through the software and it will be done automatically. There is no person involved in recording these things. Everything is already aligned with the software. There is no specific need to record personally, physically, we are seated and we are recording anything. No. So that is why these type of things will not be possible. These type of clerical errors right now is not possible. It is a clerical error. So that's why
No,
even the
but
auditor will
sir,
not be looking
this
into
you
that.
cannot say for all the companies. But like I don't disagree you, but cannot that cannot be said that all the listed companies or all are following this mechanized software, or this way that
But
because I think
it
there are a
will,
lot of places where they are doing it manually as well to some extent, and then it is being automated to. So it is you can say it is a semi-automated sort of thing.
so this is something if these type of things will be there, again, as an accountant, if I am into the preparation service, I'll not go into very detail. So that will be something I have to go into very detail. If out of 199 is completed, one is missing. If I'll say like out of 180 is being done, 20 is missing, then something I can look for. But mainly when I'm preparing the financials, I will be looking for all the transactions mainly. But if any transaction is not coming into like a picture, will not be provided, any invoice is not providing by the organization itself, then what we can do in that case? We can do nothing. So most of the time it will be the duty of an auditor, not an accountant. Now we are coming to the compilation. So in the preparation, we are talking about preparing the things. We are preparing the accounts. When it comes to compilation, it is like to apply the accounting and financial reporting expertise. Somebody who is helping in the compilation, they will be applying their expertise to assist the management in presenting the financial statement without providing any assurance. They're not providing any assurance. They're just saying how you have to present it. That's it. No assurance, neither negative, neither positive. Accountant does not verify the accuracy and completeness, and they will be compiling on the basis of whatever the information provided by the management. They're not going into very detail. In the preparation, mainly service. So unlike a preparation service, the compilation requires the accountant to be independent. For compilation, you need to be independent person. If you are not independent, you cannot do the work of compilation. You have to issue a compilation report. You have to disclaim any assurance. You have to disclose the lack of independence if applicable. So objective is to apply the accounting and financial reporting as expertise to assist the management in the presentation of financial statements without undertaking to obtain or provide any assurance on them. We are not providing any assurance, any opinion on the financials. That's it. What we are doing, we are just using our expertise and we are just assisting the management how they can present their financial statements. This is only we are doing. But for compilation, we need to be independent. If we are not independent, we can't do the compilation work. Even if we are independent, we are not independent, even if we disclose that we are not independent person, if we are disclosing it, that's fine. It's allowed. Next is review. Review means to obtain the limited assurance that accountant is not aware of any material modification needed for the financial statement to conform to the reporting framework. What I'm doing, obtain the limited assurance as a basis for reporting whether accountant is aware of any material modification that should be made to the statement for them to be in accordance with the reporting framework. So if accountant is not aware of any material modification that is needed, that should be made to the financial statement to confirm the reporting framework, that must be disclosed. So ultimately with the review, it provides a limited or negative assurance. We are saying we are not aware of any material modification. So review includes performing the inquiry and the analytical procedure. So for review, accountant must be independent. It's less extensive than an audit. No test of control, no substantive testing, nothing is needed. What they do, they may review other historical financial information. That is something possible. So obtain the limited assurance as a basis for reporting whether accountant is aware of any material modification that should be made to the statement for them to be in accordance with the reporting framework. And for review work, accountant needs to be independent. Accountant must be independent if they have to perform the review. In compilation, independence is not mandatory, I would say. If accountant is not independent, still accountant can do the compilation, but they have to report why they are not independent. If they are not independent, they have to report the reasons for that.
So we are checking this preparation, compilation, and review thing as an auditor or as an accountant in this thing.
Right. Suppose I can take one example of review. Like ABC Limited asked a CPA firm to perform a review of its financial statement. So the review is mainly just to check whether the statements are prepared in accordance with the GAAP. So what the accountant does, accountant first confirms the independence, then perform the inquiry of the management. Means mainly inquiry, they will be checking the accounting policies, whether some unusual transactions are there. Then they perform the analytical procedures, like they will be comparing the current year sales with the prior year sales. They will be analyzing the gross margins. They do not test the internal controls of the company, but yes, financial statements are important. They do not examine any source document, any balances they will be confirming. No, this is something required in the audit. So they are providing like negative assurance, and in the review report, they will be writing that we are based on our review, we are not aware of any material modification that should be made to the financial statement. They have to just provide the management with the help that any material modifications will be needed in the financials or not. If any material modification will be needed, they, whatever the conclusion they give, in the conclusion they clearly specify this is the area where material modifications are needed.
I'm clear, sir.
What about others? Anyone else?
Clear, sir.
Any? Okay, perfect. Okay. Now we are coming to the attestation engagements. 1 second, please. So normally there are 3 types of attestation engagements. One is examination, the second is review, and the last one is agreed upon procedures. So here in this particular chapter, we don't have detailed attestation engagements. This is something we'll do it in 19th chapter. In our book, it is there in the 19th chapter. So in 19th chapter, we will be discussing about it in very detail. What is examination? What is review? Review mainly we have discussed in the previous slide as well. So when I'm saying attestation engagements, it apply when a CPA is engaged to issue a report on the subject matter or on assertion that is the responsibility of another party. This is broader than an audit, but yes, this is something is a good work we normally CPAs can do. Like subject matter which any CPA have to look can be financial, can be non-financial. Like they can look for the historical or prospective performance, like whether the company is able to achieve 10% reduction in their cost or not, these type of things. Then physical characteristics like some sort of confirmation of square foot area of the facility. Then some historical events like validation of the price of the goods on a specific date. These can be done as a part of attestation engagements. Now within the attestation, there can be an examination, review, and agreed upon procedure. Examination is similar to an audit. In audit, we have an entire financial statement. In examination, we have just a single subject matter. So these are the assertion-based engagements, I would say. So party other than practitioner can make a written assertion. Assertion states that whether subject matter is measured or evaluated using the suitable criteria. So first, I'm talking about the examination engagement. So what CPA will do, CPA directly examines and report on the compliance with the contractual requirements. In examination, they have to express their opinion on a subject matter. In review, they have to give a conclusion on the subject matter. No opinion, only conclusion have to be given. In case of agreed upon procedures, they are, see, whatever the process is being defined, whatever the procedures are being defined, we are just following those procedures and we are finding out, we are take out the factual findings. That is something is regarding the agreed upon procedures. And guys, in more detail, we will discuss in the next class. This is something I'll discuss in the next class, not now. Okay, because it will take some time and we are just out of time now. So we will discuss this particular table in the next paragraph, and we'll discuss more about examination, review, and agreed upon procedure in the next class. So we are now, as of now, we are just ending our session. And guys, one more. Guys, now one thing before we end our session. If you think like you have any doubt, anything in your mind, you want to discuss about how you have to study, you have to like know how to pass in the very first attempt. These type of questions, if you have, like a lot of you can have a doubt. So in that case, you can directly connect with me. I've already provided my WhatsApp number. I'll be providing it again. And suppose if you need like this PPT, I'll get it uploaded over the LMS as well. Okay. But if you need it now, I can share with you directly as well. That's fine. Okay. So this is all for today, guys. Thank you so much, everyone. Thank you for the time. Good night.
So, sir, one thing.
Thank you, sir. Good night.
Bye-bye.
Thank you, sir. Bye.